So this is class 5, September 8th. What we'll do is finish up our discussion on equity-linked annuities, and then we'll get started on the different types of life insurance. We'll move from annuities and get back to the beginning here, types of life insurance. And it's interesting, from the last class I recorded to this class, I was talking to a financial planner for a very specific question. I have a pension from a particular employer, and I just wanted to know the details of the pension. That's the only reason I was talking to him. He had emailed me and said, I can give you information on your retirement plan, and I said, great, let me do it. Well, in that call, he started pushing life insurance products on me. Not that he sells them or make commissions off of them, but he was just giving me recommendations, and lo and behold, he was pushing equity-linked annuities and equity-linked life insurance on me, two products I would just never buy. It's possible they've gotten better in the last several years. The article we're reading, you remember this article here? This article is dated. It's written by some lawyers who have a fairly anti-view of this product and this industry. I'm not saying every product is as bad as this research shows, but I do know the products that I've seen, there are several of them out there very much like this. And I'm going to argue, we'll see later when we do the math behind this product, when we actually get into the annuities and talk about equity-linked annuities, we'll actually set one up in Excel. I'm going to argue that if it's something you can replicate yourself, you're always better off replicating yourself than going through a life insurance company because of the high fees insurance companies have to charge. The one exception can be the tax code. Insurance companies do have special tax treatment, and so if you wanted to set up your own equity-linked annuity, you'd have to do it in a very tax-favored way, such as in a Roth IRA. But if you have that set up and you want to do it, you can certainly do it yourself. So what we want to look at is some of the characteristics of this product and understand it. Remember, this is an example. The reason it's under ethical challenges is an example of a very complicated product, very hard to understand, and I think this article does a good job. It was interesting talking to this gentleman this last week, getting into the details of the product. I could tell he really was not very comfortable. It actually got awkward that I didn't want to push the issue. I didn't want to make him feel bad or get into a debate. So I just changed the topic and told him, no, it's just not a product I'm interested in. But they're complicated. Well, one of the things that's real important to this product is you do have a minimum rate of return. Now this says 3%. 3% is a little tough to produce in today's market with interest rates so low. I do have some insurance products that I did buy that I do like that do have a 3% minimum, and I bought them when they're yielding 6%, and that 3% looks really good now compared to other products. So they say the minimum is usually going to be lower than treasuries. Well, right now treasuries are paying almost nothing. But the minimum is guaranteed in the contract, so that is nice. You could have bought one of these that had a really high minimum guarantee, and that's the reason I bought some annuities, not equity-linked annuities, but different type of annuities, because I thought they had unusually high minimums, and I'm glad I did because they certainly have provided me great protection on interest rates falling. So that's a good focus, a good part of this product is they do have a minimum. However, the minimum doesn't apply to everything that you have in this product. So there's only amount that's actually invested, and sometimes the minimum is not even compounded, which I think should be illegal, but it's possible it's not compounded. And then for some, if you don't hold it to maturity, you can actually lose the minimum. The thing I think is the most interesting in this, I haven't gotten a good answer on this, but let's say the market's up 30%, 40%, so your annuity's up a bunch, and then the market falls 30%. So you're up 40%, then the market falls 30%, now you're only up 10%. Let's say that happened over 10 years, or over 5 years. Well, the 3% isn't guaranteeing you a minimum each year, it's a compounding minimum. So you've got to be careful. If your annuity is up a bunch because the markets have really roared up, that amount can be lost because the insurance company can go back to your minimum. That's over time. So if it goes up 3% a year, and so you think, you go from 100,000, 160,000, but that minimum was only 112,000, then if you have 160, you can fall back down to 112,000. So you can, on an annual basis, lose quite a bit of money. You just know that over time, the worst you can do is make that minimum. The stock index, this is where it gets really tricky. It's usually based on some index, usually the S&P 500, although the one I saw that was just crazy, it was based on both the Dow Industrials and on the S&P 500. It had two indices. I don't know why they would have set it up like that way, except to make it more complicated. But it is a price. Most of these are only a price-only index, so it does not include dividends, which is a big part. I'll show you here in a little bit. That is a big part of the return on the S&P 500. You'll see it in a graph here pretty soon, and they talk about it here. So the exclusion of dividends changes the S&P level to understate the returns, as dividends have historically been about 1/5 of returns. And that makes sense. Historically, dividends have been 3 to 4% yields, and stocks have made 10 to 12%. Today, dividend yields are about 2%, and we think stocks will make about 7 to 8%. So about 1/4 of the return on stocks is coming from dividends. And remember from your earlier finance classes, whenever an index or a stock pays a dividend, it causes the price of the stock to come down. So dividends, you're not getting dividends, but the payment of dividends actually reduces the index. So it's actually coming out of your return. Now the next part is the participation rate, and I actually think this is the most deceptive part of this product. It's one of the things I dislike most about this product. So it tells you the fraction of the index that would be credited to the investor. That seems really simple. If it's 50%, if the market's up 20%, you'll make half of that. So if your participation rate is 50%, you make half of whatever the market does. If your participation rate is 100%, then you get 100%. That seems straightforward, but it's unfortunately not that simple. In fact, it's possible to have a higher participation rate but get much less of the appreciation of the market versus a lower participation rate. It's possible mathematically that a 50% participation rate will give you more of the stock return than 100%. And why is that? It's because of the way that it's calculated. So it's easy to compare participation rates, and certainly you want to have a higher participation rate, but it does not assure you that you're going to get more. And it's because there's 3 ways of calculating your return against the index. These are called indexing methods. There's the point-to-point method. There's the monthly average method. I forget all 3 of them. You don't need to memorize these. I'm just trying to show you how complicated these are. So the point-to-point method measures the increase in index from the beginning to the end of the contract term. In some contracts, a point-to-point return is calculated at regular intervals. Usually the contract's anniversary date and the index value is reset or ratcheted up to reflect the credited return. A more complicated method is the monthly average return method. It calculates the increase in index from the start of the year using an average month-end level return. Now this really hurts you. So an index annuity with resets, they're more valuable without resets, and point-to-point are more valuable than monthly averaging. You can do the math yourself. You can actually go back historically and say, okay, the S&P started the year at 3,000. It ended the year at 3,500, so you take 3,500 divided by 3,000, and there's your appreciation. If your participation rate's 100%, then you get 100% of that 3,500 divided by 3,000 minus 1. But if you use monthly averaging, you take 30,000 plus whatever January's number was, what February's number was. That can reduce that average by half. If the market is evenly distributed throughout the year, you can actually do the math, and I'll do it for you. So what I've set up here is, let's say the market starts at 3,000, but ends the year at 3,540. So in that case, you're up 18%. If your participation rate is 50%, then you will get 9% credited to your account. However, if they use a monthly average, so here's a monthly average. If they use a monthly average, the average is only 32.63. In that case, you're only up 8.77%. So if your participation rate is 100%, you'll actually get less credit to your account than if your participation rate was 50% if you do a point-to-point. So it's complicated, and you have to read these. You can see there's so many different methods that you really have to sit down and figure it out. This is why if you read my blog on this industry, and I highly recommend you read my blog on this industry, one of the things I recommend is if you use this type of product, ask them to give you details. I would say show me this product over 10-year periods using the last 50 years of stock markets. And you don't know what the guaranteed rate would have been, but last 50 years of stock markets, just show me how this would have performed, and then compare that, and you'll see we're going to do that later in this article. Compare that to a very simple of just put 60% in stocks and 40% in bonds and see what you would have gotten. These products are so complicated, scenario analysis is probably your only way of doing it. I would like to run almost 1,000 scenarios and just see what different outcomes I could get. And again, they did that in this article, and so we'll see that. But you just see the incredible complexity here. Now think about someone selling this. They're getting a 10% commission, and they have someone who might give them $1 million. So they're about to make a really huge commission. Do you think they're going to explain the difference between the monthly average and the point-to-point and what that means over time? I also think if you ask them, I want to see 50 years of scenarios of this product of exactly what I would have gotten, I don't think they would have been able to give that to you, because I don't think they could have set this up in Excel and really understood, because there's so many bells and whistles, it would have been really hard to fully capture. But I believe that's what the industry owes to their customers, a full distribution of the potential outcomes under different market scenarios. So an insurance company offers high participation rates with monthly averages. They can have higher participation rates monthly than point-to-point. And so the index change with monthly will be roughly half the expected change using a point-to-point. It can vary every year. Obviously, it can be very, very different. So firms using a monthly average can actually give 100% participation, and we're really only paying 50% on average. We'll show the figure here on the next slide, but excluding dividends reduces return by 64%. Now you say, I thought it was 20%. Yeah, dividends are 20% of the return, but when you take that out and you compound over time, that compounding turns that 20% into 64%. And then this chart is also going to show what happens when you apply monthly averages versus the annual reset. Monthly averages further reduces the change in the price level by 70% over 30 years. So here's the numbers. The red is the S&P 500 with dividends. So your $100 over that 30 years would have become $49.21. You can see the big sell-off during the dot-com era. If you take out the dividends, you can see that's a huge reduction. And then if you do a monthly index, you can see the reduction. So someone who thinks they're getting 100 participation, so they should be up $49.21, they're only up to $544. That still sounds pretty good, right? You went from $100 to $544. You're also really happy that you did not have this large decline, but you notice this portfolio did actually decline. So even though they say that protects you from loss, you actually did have a decline. I wish they had done this a log normal chart. It would have been a little easier to read, but you can see it makes a big difference leaving these things out. And it's the person buying this really getting what they were expecting. So unsophisticated investors might believe they're getting 100% from 100 to 463, when in fact they're only getting 23%. So this is a 10-year analysis. The previous one was a 30-year. Here's a 10-year analysis. So it's extremely material. People saying, and that's what this guy was telling me, I'm getting 100% of the market but I don't have the downsides. If we just think about that, and here's the most important key to this, someone tells you that, you have to stop and think, how are they producing that? Definitely the insurance industry is not taking this exposure right here. They're not guaranteeing you a 3% minimum, but if the market crashes, they'll take all that loss. In fact, they're not taking any risk at all, the insurance company. They're passing all of the risk onto you, but they're packaging it in a way that it sounds like you're getting a good product, but you're only getting this down here. So yeah, these are tricky products. I think hopefully you're seeing why I'm telling you, if this product comes to you, I'm not saying it's the worst in the world. There might be a good product out there, but because of its complexity, you should demand a large number of scenarios. What if the stock market goes up every year like it did in the 1990s? What if the market crashes twice like it did in the 2000s to 2010s? What happens in a year like 2020 when the market's been up significantly the last few years and then it drops dramatically in a very short period of time? What if it drops in January? What if it drops in December? What difference does it make? But I really think just go back 50, 60, well, you can get a good 100 years of the stock market. Go back 100 years on a monthly basis. You've got the data. It's out there for free. And you can actually have them run scenarios. And when you ask for that, I think what you're going to find is they're going to tell you we can't do that. And that should tell you a lot. If they can't actually produce that for you, that means they don't know and they don't care, or they do know and they don't want you to know. Either way, it tells you a lot about the product. So there's ways to really irritate these people that are trying to get their commission where they may not have your best interest at heart. If they have your best interest at heart, they'll show you this stuff in a second because they want to prove to you that it's a good product, and that's the best way to do it. So we're talking, these charts I just showed you are looking at the gross number you paid in. But there are some firms that charge a spread, so there may be an extra reduction to your return. So they say, yeah, your participation rate is this, so you should have gotten 18%, but you only got 9%, but then they take 3% off of that, so you only get 6%. Some also use caps. Caps can be really expensive. The stock market doesn't just go up 7-8% every year. It usually goes up 30% one year and down 10% the next. Well, if you have a cap and it says the most you can get in a year is 14%, that can have a huge impact. Just look at this last sentence. The effect of annual caps is dramatic. The annualized price appreciation, the S&P 500 from 75 to 2004 was 10%. If you had put a 14% cap on that, you would have only gotten 5.5%. So that can be really material. Again, how do you understand that? I am going to argue, and I think the actuaries in the room in our class would agree with me, stochastic analysis are running multiple scenarios over many different outcomes. That's the best way to understand something this complicated. So equity index annuities are touted as excellent investments for investors wanting market returns without the risk. So they decided to evaluate that. Might it be better for you just to take the risk? So they compared it to a combination of stocks, and they didn't even try that hard. They did stocks, probably just the S&P 500, and treasuries. They didn't even try to get more return. They just bought treasuries. So they put $60,000 in 10-year treasury strips, so they have to worry about reinvesting the income, and $40,000 in a low-cost S&P 500 index fund. And here's the stochastic analysis. Here's the treasuries and stocks. Here's the equity-linked annuities. Here's the different levels of the S&P 500. And what you'll discover is, the high probability is where the treasuries are beating. There is a point where the annuity wins right there, but extremely low probability. And you'll notice when they win, they don't win by much. So when the market really sells off, they win. When the market really takes off, they win, but only at the extremes. So you've got a 97% chance you'll be better off with the treasuries, and that 3.1% chance, even in that case, when the equity annuity wins, it doesn't win by much. So after 10 years, the expected value of the treasuries and stocks is $220,000. The equity-linked annuity is $186,000. That $33,000 shortfall can be broken down into the treasuries and stocks. When they win, they're $33,000 better off. When the equity-linked annuity wins, it wins by a couple $100. So even when the equity-linked annuity wins, it doesn't win by much. Now, obviously, they could go much lower, and they could have gone much higher. I don't know how much lower you can go than 500. The S&P at its low after the 2008 crash was 667 or 666. Obviously, it could go much higher, and it looks like if they'd gone much higher, they could have gotten a much better benefit. But it's not an overwhelmingly positive product. So, and even this overly generous to annuities because they assume people hold these to maturity. So there's no surrender charges. But if you don't do that, they have disadvantaged tax treatment. They're taxed at the marginal income tax rate, not at the capital gains rate. Even if you hold it to maturity, you're going to be taxed at a higher rate than you probably would have been on the stocks. Now that's changing with the new tax code change of 2017. We'll see with Biden, if he wins the election, what he might do to that. Historically, the normal income tax rate has been much higher than capital gains tax rate. At the time this article was written, it was 35% versus 15%. It's no longer that wide, so it's not as big of a disadvantage now. But you have those two things going on. Most people don't hold these to maturity, and so they do have surrender charges that can be significant, 10, 15, 20% of the balance. And then if you hold it at maturity and you start withdrawing, the taxes you're going to pay on it will be probably higher than what you would have paid if you'd put it somewhere else. And remember, you could set this up in a Roth IRA. If you set this up in a Roth IRA, you'll never pay tax. So you could do this yourself. I'm not saying don't put the life insurance product in a Roth IRA, but do exactly, and we'll talk about this later when we set up the equity-linked annuity. If you were to do exactly what this life insurance company is doing, except for you do it yourself so you don't have to pay the fees, and you do it in a Roth IRA, then you can do it much more tax advantage than the insurance company could have. Equity-linked annuities do not have explicit annual fees or expense ratios, so the insurance company makes money simply by taking some of that return that it was promising you on the S&P 500, like how they do the participation rate. All right, so the conclusion, the last page of this article, equity-linked annuities are complicated. Complicated investments sold to unsophisticated investors. Now, the guy talking to me was a financial planner, strong background in this area, but not an investor, so I doubt he did much research on them. Not good regulatory safeguards. We'll talk about that here in the next article. So if you bought the stocks and the bonds, you would have much more protection than if you buy this equity-linked annuity from a regulatory standpoint. Registered reps, insurance brokers, retail investors, few PhDs in finance can understand these products. About the only way I can understand them is to have someone set them up precisely perfectly and run scenarios. The net result of these annuities is complex formulas and hidden costs, and they survive as the most confiscatory investments sold to retail investors. I don't like them. I think they are really bad. I cringe anytime I hear someone that's bought them. I don't assume that's the reason I had the two people that have these. The reason I didn't continue the debate was I wasn't 100% sure their product might not have been one of the better ones. Maybe it was a little better. Maybe you've only done a little bit worse than what you could have done yourself, and you had the advantage that the insurance company handles all the trades for you. I don't know. I didn't want to look at it because I was too scared to. I also didn't want to look at it because it's so complicated. It would have taken me hours to figure out their exact product, and I just didn't want to mess with it. It was their problem. So let's look at the update. There's a second article. It's the equity-linked annuity article update. And there was a big debate during the financial reform during President Obama's first year. It really looked like equity-linked annuities were going to be regulated by this SEC. And the SEC regulates investment products, the Securities and Exchange Commission. And it looked like it was a done deal. So let's read through this article and you'll see that it didn't quite work out, and you'll see why, because of the way this industry works. So some advisors say that means inappropriate sales of the product will continue. The first deputy commissioner of the Iowa Insurance Division says a new suitability model developed by the NAIC, those are the regulators, will offer additional investor protections. So some advisors don't hate these products, and they think it's going to be continue to be ripping off the customer. The insurance regulators actually like these products. Why? Because they're regulating the insurance industry. They feel like this is their thing. They don't want the federal government stepping in. They want to keep them out. And so they're actually fighting for the industry, and they're saying they're putting in new safeguards to help investors. It'd be interesting to see what those protections are. That's something I should probably go research and add to this class in the future. The products have high commissions. The agents have been criticized for inappropriate sales of the annuities, bad sales practices, all the upside without the downside when you really don't have all the upside, particularly taking advantage of the elderly. Index annuities issued after 2011 would have to be registered with the commission and sold by registered broker-dealers. That was that new rule if it had passed. It didn't pass. But if it had passed, the SEC would have required, and we'll talk about this a little bit later, we'll talk about the safe harbor rule that equity-linked annuities fall under. And the SEC was going to take that safe harbor rule away and say these are not insurance, these are investments. So this was the rule that came out, it was going to come out, and it actually was passed and was going to work. But the Financial Planning Coalition group of financial organizers said in a statement Thursday it was disappointed. The SEC was stripped of its authority to regulate the equity-linked annuities, so you can see this rule got destroyed. That reduces investors' protection by preventing the SEC from preventing abusive sales practices. So the SEC was going to step in and do this, and then it got kicked out. And it just has to do with the power of this industry. Many of the equity-linked annuities carry very high sales commissions, have very long surrender periods. We talked about that. If you don't hold it to maturity, you can really pay a lot. And some insurance agents, 14% commissions. Can you believe? So let's think about this. This is real important. Your finance majors, your actuaries, you know how to do, basic economics. An insurance company is going to take $1 million of your money. They're going to take $140,000 of that, hand it to an agent. So they only have $860,000 of your company, of your money. The insurance company has expenses. They have risk. They got to set things up. They're going to buy the same type of investments you would have bought if you try to set this up yourself. How is it even humanly possible that this product could do better than what you could do yourself? 14% comes off the top, so you only have $860,000 invested with them. They're then got to pay their own expenses. That usually ranges from 1 to 2% of whatever you give them. That's their expenses every year. So that's not 1 or 2% up front. That's 1 to 2% every year is what their expenses are. How can you possibly do better with an insurance product that pays a 14% commission? There's no magic. I think some people buy these and think the insurance company has some kind of magical investment they can do to produce these things that no one else can do, but they don't. They're investing in the exact same thing everybody else is investing in. Here's someone from the Gradient Financial Group. They sell index annuities. They disagreed, saying so much is already being done that adding another layer of regulation we felt was almost make it worse. So they think we're being overregulated. Some in this profession think equity annuities are grossly underregulated, so there's a lot of debate here. Index annuities are currently one of the safest ways for retirees to allocate their money to make sure they have retirement income, according to him. One of the safest ways. It might be a very safe way to do this. Now you have to realize, because this is not regulated as an investment product, it is on the insurance company's balance sheet. These are not segregated assets. We'll talk about variable insurance products later and how they're protected because They're taken off of the insurance company's books. These are safe in terms of if the stock market crashes, you have some protection. However, if the insurance company goes insolvent, you're at just as much risk as anyone else who has an insurance company go under. So you're risking the credit risk of that insurance company. So if you do $1 million of this, you have $1 million with an insurance company. If they go under, you do not have the FDIC protection up to $1 million. Your protection might only be $200,000-$300,000. So you have to be careful. You do have exposure to the insurance company. James Taylor says he has never sold and would never sell one. So you're seeing two different people, Tony versus Jerry here. I studied them with great interest since they came out, but the product's limitations are an issue. I cannot represent to a client that he's going to participate in the S&P 500 because he's not. He's only going to ostensibly participate with minus signs and a cap. So there it is. I'd encourage you on this ethical question that you have to handle. It's probably the hardest question on the first exam. Try to find some ways to bring in this article. You've got the article and you've got it. I've got a highlighted version. I'm using the same highlighted version here. So you have that on Blackboard with the highlights, both of these articles. And I'm using this as an example of the complexity of this industry and how they're able to really take advantage of their customers by just hiding behind the complexity. And I've seen these sales practices, and they talk to their clients in a way that only a stupid person wouldn't understand this stuff. They make you feel, they really put you on the edge of, wow, if you don't understand what I'm saying, you're not too bright. So they'll say, wow, you see how it works? Yeah, really simple, right? No one wants to say, no, I don't understand, especially elderly people. They don't want to insult someone or upset someone. So that's why this is why you have to stick to your guns and say, fine, I see what you're selling, looks interesting. What I need is you to show me 100 simulations of all different stock market and bond market returns. I want to compare this product to if I just put 60% in the stock market and 40% in the bond market. I want to look at it under every scenario, and I want my 1 million invested in the 60-40 versus the $1 million I give to the insurance company minus all the fees and all the commissions. I want to make sure I'm comparing to exactly what I could get on my own versus what I'm getting with the insurance company. So that's what I say you should always do. Ask the hard questions, and if you find a product that looks really good, then buy it, invest with it, but don't do it until you do that. All right, so we're about halfway, a little over halfway through the class. So if you want to, right here, hit pause, go get something to drink, get something to eat, stretch, pet the dog. I'll let you take a break right here if you'd like to. Okay, so we'll do a kind of high-level introduction to the life insurance. So remember this industry. There's 3, maybe 4 main products. Let's say 4. It's disability and health, disability insurance and health insurance. I'll treat as 2 different things. So we have life insurance, we have annuities, we have health insurance, and we have disability insurance. So those are the 4 that we're going to talk about. We might talk about some of the specialized insurance like Key Life and bank-owned and corporate-owned life. Those are really life insurance products. They fall under this, but we'll cover them at the very end and catch all other products. So we'll start with life insurance. So life insurance doesn't insure you against death. It insures you against premature death because everybody's going to die. So what we're worried about is someone dying too early, and especially as you're working on this human capital paper, someone who dies during the time where they still have a lot of human capital left before they've retired. So unlike property and casualty insurance, if you wreck your car, you can wreck your car 6 times in your lifetime. Life insurance, there can really only be 1 claim in your lifetime. I'm sure there's somewhere in the history of the insurance industry where someone received more than 2 life insurance claims. And we might talk about that. Someone who was lost and presumed dead, maybe they were lost for 7, 8 years. And an insurance company will say, okay, if they're lost, maybe they're lost at sea. And the most logical assumption is that they're dead and they've been missing for 7 years. They'll just assume the person's dead and they'll pay the life insurance. It's possible they will do that and then that person actually is alive and they buy another life policy later. But that's pretty rare. So we're assuming most people only have one claim in their lifetime. So there's no partial payments. You either die and get the money or you don't. The policy always pays cash. So with your auto insurance, they may not pay you cash. They might pay the vendor who's the repair shop that's fixing your car. For health insurance, they may pay the doctor or the hospital. Life insurance, they just pay cash directly to whoever the beneficiary is. Insurance is not a contract of indemnity. It's actually what's called a valued contract. A contract of indemnity is they're trying to bring the person back to the same position they would have been in before the loss. So you wrecked your car, auto insurance is trying to bring you back to where you would have been if you've never had the accident. Life insurance doesn't do that. Life insurance simply says if you die, your beneficiaries get the face of the policy, the $100,000 or whatever. So it is a fairly unique insurance versus all the others. Annuities are very unique as well, and you'll cover that in your first paper. Important within all insurance is something called insurable interest. This is not just important to life insurance, but it's important to all insurance. So what we mean by insurable interest is that the person buying the insurance would prefer that whoever's life is being insured, they would prefer that that person stay alive, even considering the insurance proceeds. So we want the person to prefer they're alive versus dead. Now, I love watching these real life crime shows, Forensic Files, Deadly Women, and life insurance is a big part of this. I'm going to show you an article a little later that's a little bit shocking. There was one forensic file. These sweet little ladies were finding these elderly homeless men and getting a relationship with them enough that they could buy life insurance on them, and then they were just killing them and collecting the life insurance. And they I forget how many lives they took, but it was pretty interesting what they were doing. Because they're homeless people, there was no one to check, no other dependents. It was pretty amazing. I might show you the true case, which is a USAA case where USAA was sued. There's actually a forensic file on that. I'll look for it. We might use that as a substitute for a class one time just to have you see how interesting this industry can be. So we'll see. I did that with my PNC class. Those that took my PNC class, remember I gave you a case with the Ballard House in Dripping Springs related to mold. So it's interesting. The forensic file, there's a lot of shows there related to life insurance because life insurance is often the reason people are being killed. We'll get into that a little bit. I have a good friend who actually did claims, paid the claims in the cash management area of a life insurance company. And boy, the stories he could tell. He's on Facebook with me. Maybe I'll ask him if he would ever be willing to come talk to our class and tell us some of his gruesome stories. He doesn't do that anymore. He's moved on to another career, but I'm sure he still remembers some of those stories. So what does insurable interest mean? So if you're insuring your own life, insurance industry assumes that you have insurable interest in yourself. There is the issue of one taking their own life, and we'll talk about that with the suicide clause. But for the most part, if you buy insurance on your own life, you don't have any issue with insurable interest. There is no legal limit to how much you can insure your own life. If you want to buy $10 billion of insurance, life insurance on your own life, that's perfectly legal. Now, if you do that and they find out about it, they're certainly going to question. I mean, if you want to spend millions and millions and millions on life insurance and you buy $10 billion of life insurance and then you die the week later, believe me, there's going to be an investigation. But that's very different than health insurance or auto insurance. If you have 3 or 4 policies for disability insurance, health insurance, only one of them will pay. Or there might be some pro rata or something, but they will not all pay. One will be primary and the other secondary, or there'll be some kind of co-insurance. One might not pay you because another one paid you and they'll just give you your premiums back. But for life insurance, You can buy 6 policies and all 6 of them will pay. Insurance companies may have limits. So one company might only be willing to sell you $500,000 of insurance, but there's nothing that keeps you from going from 10 insurance companies and buying $500,000 from each one of them. That's perfectly legal. If the insured and the policy owner are not the same person, insurable interest must exist at the time the policy is taken out. However, with life insurance, insurable interest is not required after that point. For all other insurance, insurable interest must always be in place. So you cannot buy auto insurance on your car and then sell your car to your 16-year-old neighbor and they keep that insurance going on that car. That's not allowed. But if 2 people are married and one has life insurance on the other and they go through an awful divorce, and I'll tell you a story that's actually very much this story. They go through an awful divorce, that insurance can stay in place even though they don't really and truly have insurable interest. They're no longer married. They no longer have any financial dependency on each other. They may hate each other, may even hope the other person dies. They may be so mad at each other, but they can continue that in life insurance, and insurable interest will not give the insurance company an excuse to cancel the policy. Now, one way an insurance company protects itself from insurable interest is to make sure the life that's being insured signs the contract. So they must give consent. So if your neighbor comes over and says, hey, will you sign this form? You say, what is that? Oh, don't worry about it. And you find out it's a $500,000 life insurance policy on your life. That will probably make you very nervous, especially if your neighbor just moved in last week and you've never met them before, and they're now buying $500,000 on your life. We'll get into this a little later, insurable interest, when we talk about corporate-owned and bank-owned life insurance, that your employer can buy life insurance, where if you die, they get a large payout. We'll talk about why is that insurable interest. It's a big debate. Companies do that for tax reasons, as we'll see. But the big debate the IRS had with those products was, is there insurable interest? But so far, those have passed the test for insurable interest. All right, so another issue in addition to insurable interest is anti or adverse selection. This is a huge issue for life insurance and for health insurance. And what it says is that those who need insurance are more likely to buy it. Unhealthy people are more likely to buy life insurance than healthy people. Healthy people are more likely to buy annuities than unhealthy people. Unhealthy people are more likely to get the best health insurance they can get. So if someone thinks they're not going to live very long, they want to buy life insurance. However, the life insurance industry protects themselves by having you fill out a health questionnaire that may require you to give have a blood test, or have even a physical exam depending on the amount of insurance. There is a lot of life insurance that's sold without a lot of examination, but you do have to always fill out an application. So if someone just found out they have a terminal illness, they'll have to put that in the application. If they lie in the application, the insurance industry will investigate these claims. And if the person bought the insurance and they die 3 months later from a very serious cancer, and the insurance companies thinks, well, surely they knew they had the cancer before they fill out the policy. They can investigate and they can deny the claim if the person lied on the application. So there are ways to protect themselves from adverse or anti-selection. Now the next one is moral hazard. This is a big issue on the property and casualty side. I don't think it's an issue. You can think through it. I've always asked students, can you think of a scenario where moral hazard applies to life insurance? So what is moral hazard? The very act of buying the insurance makes you behave more risky. So I always give the auto insurance example because it works better on auto insurance. So you buy a $200,000 Ferrari and you're at the dealership, you're about to drive it home, and you just realize it's 8 o'clock at night and you forgot to buy auto insurance. So you have no auto insurance on this $200,000 car. How are you going to drive home that night? You might even ask the auto dealer if they can keep it at their place, and they'll take the liability, but they may not want it. You've bought it, it's your car. So you might drive very slowly, and every time you see another car on the road, you might pull over and park, get out of the way. You might get home, park it in the garage, and you might actually sleep in the car with your dog, although you don't want the dog to mess up the car, so whatever you have with your shotgun. Next morning, you call your insurance company, you get your auto insurance on it, you just realize you're going to be spending $30,000 a year for auto insurance. You hadn't thought about that before, but now you have auto insurance. Now you become a much riskier driver. You don't sleep in your car, in your garage with your car. So you become riskier. And that's true for everybody when they buy auto insurance. They're riskier drivers when they have auto insurance than when they don't have auto insurance. Now, is that true for homeowners insurance? Maybe a little bit, but I doubt it. Is it true for health insurance? Do people not go bungee jumping because they don't have health insurance, and as soon as they get health insurance, they go out and start bungee jumping? Do people not go bungee jumping because they don't have life insurance, but as soon as they get the life insurance, they do? I don't know. I think with health insurance and life insurance, you have so much skin in the game, literally, that by itself is going to control how much risk you take. Now, we'll talk about this a whole lot more with health insurance. Why don't people eat healthy? Why don't people exercise when they have so much at stake? And I doubt people are eating unhealthy and not exercising because they have health insurance and that will pay all their bills. I think there's something else, but we'll talk about that. That's a big issue with health insurance. So moral hazard is not the same. If you take the E off and just call it moral hazard, moral hazard is when you buy insurance with the intent of it causing a claim. So you buy homeowners insurance and then you burn your house down. You buy auto insurance and then you intentionally run the car off the cliff. That is illegal. That you will go to jail for. Those ladies who were buying insurance on men that they then killed, that's illegal. Obviously, murders are illegal. But buying insurance in order to defraud the insurance company is illegal. That's moral hazard. We're not talking about that here. We're talking about moral hazard. Moral hazard is perfectly legal. So insurance companies actually price for this. For anti-selection, insurance company know less healthy people buy more life insurance, and so the simple fact that you're buying life insurance, that tells the insurance company you're more unhealthy and they'll charge you more. Healthy people buy more annuities. The insurance company knows that, and the simple fact that you buy an annuity, they're going to charge you more. They put you into a different mortality table. For moral hazard, auto insurance companies know as soon as you buy auto insurance, you're going to drive more hazardly, more risky, and they charge you more because of that. And there's no way to get around that because that's just human nature. All right, so the types of insurance we're going to cover, not all of these in detail, but we'll start with term, and then we'll go to permanent. You'll usually hear it as term and perm. But term insurance has some term stated in the policy. Well, we'll see, 1 year, 10 year, and then permanent. Permanent has cash value, so it actually has an investment aspect to it. So it combines a savings element with the insurance. So you see the word bundled. Some of these products are more bundled than others, but it's a bundled product where you're buying both insurance and an investment. So the guy who talked to me this week, he had an equity-linked, index-linked, universal life policy. Just, to me, the most complicated thing anyone can ever buy. I don't know why he would buy something that complex, but he liked it. He thought it was a great product. Why you would do that versus a variable product, I don't know, but that's what he did. So we'll talk through these. So before we do that, though, I want to cover a few issues, kind of overall issues. The first is the type of premium plans that you have. So some insurance can reset annually. So annual term, where you're buying term that just lasts 1 year, that is reset every year. Now, usually it's a guaranteed rate, and what that means is the rate will increase with age, but the general age of everybody in the mortality table. So if you get really sick the 5th year, you're going to increase the rate the 5th year, but only because you're older, not because you're sick. So they're going to go by the general mortality of overall people. So they won't charge you more because you're sick, but they will charge you more because you're a year older. Then you have level premiums. So they'll say, we'll talk about level term. 10-year level term is my favorite type of insurance. I think it's a great product. It's really, I think, the primary insurance product most people should be buying. So here I am pushing a product, but you have to decide. But Level, it's guaranteed the same premium for say 10 years or 20 years. Those are pretty popular. We'll look at the 10-year Level term, pretty popular product. Then you have an ordinary whole life. You pay the exact same premium for the rest of your life. This is the ultimate Level premium. You'll pay it. Some of them stop at age 100. So if you make it to 105, you just stop paying the premium. Even some insurance companies, if you make it to 100, they just pay the face of the policy even though you didn't die. That may be changing now that mortality tables have jumped out to 110 and 120 years. But so it's one premium your entire life. And then the last one is a limit pay. And we will be pricing all of these later in the class when we price them, and I'll show you how to do the math. It looks really complicated when you first look at it, but as you get into it, you find that it's actually quite simple. Most students do very well on those questions. So that's limit pay, whole life. Ordinary, anytime you see the word ordinary, you pay the premium until age 100 or until you die. Limit pay, whole life, you pay the premium for whatever period of time, 10 years, 20 years, but the insurance lasts your entire life. Level term, you pay the premium for 10 years and your insurance is for 10 years, and after the 10 years you no longer have insurance. So the first two are really the term insurance. The next two are your whole life or permanent insurance. So what I did, this graph is really hard to read, but I'm going to show you a better one. I zoom in on this chart on the next two, but what I did is I used an actual mortality table, and I priced these using actual numbers. I used the 1980 CSO table, which is what I like to still use in this class because of its simplicity. We'll talk about more recent tables that have come out, but it's hard to see it, but the annual term is this blue line. You can see as people get old, it just shoots way up. Then we have the level term. The level term every 10 years. I just price it every 10 years. You can see it essentially moves with the annual term, but it's fixed. So it's higher than the annual term for a few years, then it's lower than annual term. All the way throughout, higher and then lower. Then you have the ordinary whole life, and that's just this gray line that goes forever. It's at the end, it's the lowest premium. At the beginning, it's the second highest premium. The highest premium is the limit pay at the beginning. You have to charge more at the limit pay than you do at the ordinary because it only lasts until age 60, whereas the ordinary you get more premiums. Let's zoom in so we can see a little bit better. Here I go from 25 to 70. And again, with the level term and the annual term, you can see how they move together, but just kind of stair step on the level term. And you can see the ordinary is lower than the limit pay. And if we zoom in one last time, you can see a little bit better. Here I just go from ages 25 to 50. So you can see the ordinary is much more expensive, and we'll talk about that, much more expensive than level term, up until about age 60 or so. And the annual term is much cheaper. At about age 50, the annual term gets more expensive than the ordinary. So if someone bought ordinary here, and they live to be 60, 70 years old, they're in good shape. They're paying a really low premium, but they still have life insurance. If they bought the annual level term, they probably would have given up buying the insurance once they hit 50-something. And then the limit pay is going to be a little bit more expensive than ordinary life because you're not paying as many premiums over your life. So remember this, it's pretty important, and I use actual numbers here. The first chart I did of this, I just made up numbers, and the chart didn't actually look right. So you're my first class where I actually went in, used the mortality table, and actually built the actual numbers. You can see when you're young, level term versus annual term doesn't make much difference. However, if I did a 20-year, you would see it does start to make a difference, and a 20-year level term I think is a much better product than the annual term. So anyway, but that just shows you how these products work. Gives you a good sense of where we're going when we do the pricing of these policies. Because we're going to actually calculate these numbers. What I just did on this page, you'll be able to do this chart. You'd be able to build this chart by the end of this class. Right now, probably you have no clue how to do it. If I were where you are right now, I would have no clue how to do it. But by the end of the class, you'll be able to do it. So that gives you a good introduction to the class, to the product. I do want to talk a little bit about the tax treatment. I hate taxes. I am a CPA, but I don't do taxes except for my parents, and Every once in a while, someone will beg me, and I'll do it just out of obligation. But but high level tax treatment, life insurance is very favorably taxed. There's no question about that. I actually think if they changed the tax law and took these tax benefits away, I think the life insurance industry could shrink 60, 70, 80%, just because the tax treatment is so huge for these products. So the death benefits are not taxable if you did it correct. It is possible the death benefit can be taxable depending if you took a tax deduction for paying the life insurance premium, but most people don't. So 99% of the time, the death benefits are tax-free. The investment gain on the investment part, so the cash value part, that is taxable, but it is deferred. So if you don't get the death benefit, instead you take the investment component of this product. So all you have to do is pay tax on that you earn over and above what you paid in premiums. Now, there was a time where people were taking advantage of life insurance and made it look like they're buying life insurance, but they're really just buying investments that had very minimum life insurance benefits to them. And people are using that as a way to really protect themselves from taxes. And the IRS came in with some new rules, and they classified some of this life insurance as what we called modified endowment contracts. And we'll talk about modified endowment contracts later. I love them. They're a great product, but they're not taxed as favorably as life insurance is. And so what people were saying, so a modified endowment, this is a product where, let's say it lasts for 30 years. If you die in the next 30 years, it pays a death benefit. However, if you don't die in the next 30 years, at the end of 30 years, it pays a living benefit. And people were saying, well, that's life insurance, and it's a life insurance benefit, so that should be tax-free. So since people are setting this thing up so that they get it tax-free whether they died and got the money or they were living and they got the money, and the IRS said, no, you can't do that. That's not a claim. And so the tax on this is not favorable for MECs. They don't get that favorable, but it's still fairly favorable. You do get a lot of the tax deferral. I think they are really good products. I'm going to show you a product I really love that is a special type of MEC that I think is a great product. So that's our introduction. That's a lot to take in. Where we're going to go next. So those of you interviewing with this industry, there are certain things you have to understand with this industry. And one of the most important things with this industry, definitely the human capital and the annuity articles that you're doing are going to help you a lot with interviews with this industry. That's understanding the economics of it from the insured side. But when you're trying to learn an industry as complicated as life insurance, you've got to learn the products. So you need to understand what is a permanent, what is universal life, what is variable life, variable universal life. I'll show you some of these products because people come to me with these products when they have a problem. I'll talk about some of the downside of these products. They can get really messy. I gave you Donya's story on the annuity side, but I'll give you some of those stories from the life insurance side. So you need to know the products, understand them, and then on the exam you'll see how I'm going to actually test it in order to understand the difference between permanent insurance and term insurance. So we'll stop it there about an hour into the session.